Hello and welcome to a brand new episode of Masterclass with Utpal Seth. The three big broad topics which we would be discussing in this episode of Masterclass is value creation, what leads to value creation, value destruction, what perhaps is that big moving part which could lead to value destruction when value comes down, and then what about value migration, how does value shift. Now, prima facie, they may sound as complicated, but over the course of today's episode, we would be really breaking them down with Mr. Seth. Take a deep dive into these three concepts: value creation, value destruction, and value migration. Now, for someone who's just tuned in, he would say, "What value hai?" Let's discuss all the components one by one. Value creation. To put it very simply, value creation is when a company or a business creates value. And value is a function of demand, customer satisfaction, and shareholder satisfaction. What is the basic primary driver for value creation?
So Nikunj, I would like to clarify that we are talking of value creation, value destruction, and value migration, all in the context of creative destruction. Yeah. And we are talking about creative destruction itself in the context of terminal value investing and guerrilla companies, which become guerrilla companies by dint of the megatrends, leadership, and intangibles. So most investors think that they are doing the wealth creation, and they are, because they are allocating capital, they are managing risk. But they are actually participating in the process of value creation. Value creation is done by the companies, by the management teams, by the promoters. And the wealth creation of investors is only a function of the value creation done by those companies, promoters, and management teams. Once we are cognizant of that, then we can be clear that in the context of creative destruction, companies need to be both adaptable and agile to continue to move from one S-curve to the next, or to put it in another way, to continue expanding the TAM and the SAM and enlarging the cap and the gap, which is total addressable market, serviceable addressable market, competitive advantage period, and the growth advantage period. We've all seen that investors would like to buy, let's say, great businesses, good managements at reasonable value. But what is the priority out of these three variables? Right? For some people, the valuation is the priority. For some people, the business quality is the priority. For some people, the management quality is the priority. I think in a fast changing world like we are in, and where value shifts and value migration is happening in larger and larger quantum and at a faster and faster pace, one has to be with adaptable and agile management teams. This new age companies that we are talking about have a win the world mindset, okay, where scaling does not have conventional constraints. Most companies think of growth in a very finite way, but in new age business models, maybe networks and platforms, the marginal costs are constantly dropping or are very, very low, and therefore the returns to scale are phenomenal. The marginal value creation of adding one customer is so massive in the context of the cost of acquiring that customer, right? So we know that a lot of venture capital funds use LTV to CAC as a framework of looking at companies. But Here we have the opportunities of using LTV to CAC in the context of really mature scaled businesses who have already established either leadership or dominance. So I feel that value creation in this day and age is very different and is much less constrained as compared to the past.
Okay. Since you spoke about it could be a shift in cost structure, it could be a shift in technology, it could be a shift in the supply chain. Just to relate it for our viewers, China plus one or shift of manufacturing, can I say that also is a clear example of what you're trying to perhaps apply?
Absolutely.
That how shift in technology and shift in supply chain actually would benefit a country like India?
Yes. I mean, that's a very powerful shift that is taking place. I mean, Chinese manufacturing sector is probably 10 times the size of the Indian manufacturing sector. So, 1% displacement from there to India leads to a very large percentage growth in India for the manufacturing sector. However, it is not just limited. So, this is displacement, one of the 4 Ds that we talked about. But let me give you an example of demographics, one of the 4 Ds that we talked about earlier. We all know that India's youth, which is below 25 years of age, is more than 50%. But think of it this way, in the next 20 years, the population which is greater than 60 will be growing by leaps and bounds in India. So, we know that when societies age, like in Japan and in Europe, what happens, and India is far away from that. But in the interim process, there is going to be a dramatic increase, percentage increase in the population which is more than 60. Like we talked about other examples there where urbanization is going from 30 odd percent to 40% plus. That will be, I mean, in the last 20 years plus, we have gone from 20% plus to 30% plus. Now in the next 15 years, hopefully we will go into 40% plus. These shifts in urbanization will also drive many changes. So, keep in mind that creative destruction can happen because of all of those 4 Ds: disruption, displacement, demographics, and discontinuity.
Okay. Now, you spoke about Microsoft, you spoke about Adobe, but with Microsoft there was also Netscape. A lot of companies which in a sense were powerful guerrilla companies in 1990-2000, some of them they ceased to exist. So the whole idea of value destruction, how does one really figure it out? And what are the characters again which would tell you that okay, this business is losing its relevance or value?
Yes, because you used a powerful word, relevance. So terminal value has a lot to do with relevance in the minds of the customers.
Yeah.
Okay, and which is why leadership should not lead to complacency in today's day and age. As we have discussed in earlier episodes, your future competitor need not be from your space at all. Right? So value destruction can happen even in this era of change, but it will actually happen at a much faster pace than before. For let us say the Washington Post was listed, for the value deterioration, imagine how many years it took. And you gave the example of Netscape, imagine how fast was the value deterioration. Same way, which is why it is even more imperative for investors to be conscious of creative destruction, because if you miss being on the right side of that creative destruction, then the consequences on your portfolios are very adverse. Right? Value destruction can happen either because you are no longer in touch with changing customer needs. It could also happen because you are no longer in touch with the value propositions that the customers require and which others are offering by leveraging technology and you are not, you could also be destroying value by not adapting to newer supply chain models or newer sourcing capabilities and so on. We are all excited about EVs, but think of it, battery technologies are shifting. Right? What will be the value implication for current leaders if they don't adapt to the change in the battery technologies? There will be management teams which have that adaptability and there will be management teams which are not adaptable.
In Indian context, do you think that Indian companies, very few Indian companies have the ability and the capability and the mindset to really keep on, migrating through that S curve? Because a lot of Indian companies, which were great companies, now are becoming complacent. A lot of companies, whether it's by choice or because of management style, they're not really able to adopt to what really the scope of the growth is, or perhaps the size of the opportunities. You think in India there is a challenge?
I think it's not just in India but globally. Every company has to wake up and smell the coffee that this is the new reality, right? That the world is changing. Darwin taught us the importance of adaptability. Those who do not adapt do not survive. So I think that is a given. But take it a little further and you will appreciate that when these value shifts are taking place, the leaders have a lot of advantages too, okay, because they already have the customers, they have the cash flows, and if they don't utilize maybe the networks and the platforms that they already have to evolve even more, then they are themselves to blame, right? I know it is not easy. It's easy for us as investors to criticize management teams if they fail to adapt. But that window of opportunity in which, even if you're not the first mover, can you be the second mover and scale faster and better than the first mover? That window of opportunity is continuously narrowing. And Indian management teams, I'm sure, are realizing that, just like globally management teams are realizing that.
I'll phrase my next question slightly differently, which is that when you look at Indian companies and Indian promoters, what they were 20 years ago versus now, what is that one big change you see when you speak to promoters and when you try and understand their vision? Has something changed dramatically in last 15-20 years for Indian promoters, and if you compare them with global promoters?
I think the quality of Indian management teams is not second to anyone globally.
Okay.
Indian companies are demonstrating very good qualities. We all know that corporate governance and all are now world standards, but the sheer competence of Indian management teams are also phenomenal. There is, in every decade, you will see a new genre of entrepreneurs coming through with newer business models and creating value. And that is the case this time as well. It's just that the ecosystem to encourage entrepreneurship and risk taking is far better today than it was, say, 20-30 years ago. I also feel that today the ability to leverage not just technology but also data and data analytics that corporates have is vastly different from what it was 20-30 years ago. So I do feel that management teams have evolved over the last 20-30 years, and the pace at which they continue to learn and evolve is actually breathtaking. I think as an investor, one is fortunate to be in these times.
the purpose of capital market or stock market is to provide capital to start a business. But given how private capital now is easily available, good idea is backed by great investors. For the viewer who's watching the show, he understands the idea of terminal value investing. He knows this is a great business. But the fact that a lot of companies, by the time they would go public, they will not be small, they would be in the nascent stage. Do you think that is a restrictive investor for investors right now? That a lot of good companies, before they go public, that's the time our viewers can really invest into it. They will miss on the early opportunity.
Sure, I think, see, there are different horses for different courses. You're right, there are opportunities that public market investors don't get because of the companies that come to the markets are in a different phase of their life cycle. However, they also don't get the mortality rates that companies have in their early stages, right? So one has to look at it on a risk adjusted basis. And if your time horizon is long enough, as a terminal value investor, I feel that if the runway is long enough, then why worry? When Apple goes from $5 billion to $50 billion, that's massive. But the same Apple also went from $50 billion to $500 billion, and then from $500 billion to $3 trillion. So I think, like the universe, if you see, as you keep zooming out, things, your perspective changes.
Sure.
In the same way, I don't think as a public market investor or as a private equity investor, I have any sense of regret of not participating in the venture capital stage. This is what works for me, and I'm sure there are other things which work for other people, and good luck to them. I'm sure it works for them.
So such a great point here. The definition of universe is that it is also expanding, and that is India for you. The size of the opportunity is always expanding. But before we wrap this episode, concept of value migration, and while you spoke about the Microsoft example, a classic example here which everybody talks about, Amazon and Walmart, MTNL and Bharti in India context. How does value migration work in the context of terminal value investing?
I think value migration is evident almost everywhere that you see. Traditionally, we've talked of value migration from one player to another within the same sector. All the examples that you gave were like that. But increasingly, value migration is happening across sectors, across geographies, and so on, maybe across product categories also. So one must recognize what are the value migrating forces and pursue those. Like you remember the Watergate scandal,
Yes.
right? And there's the source, Deep Throat, said, "Follow the money."
Yes.
Right? Here in value migration, I would say, follow the change. Look at where the quantum of change and the pace of change is massive or disproportionate, and then you will find your investment opportunities accordingly. Value migration is a reality, and we've talked about sectors, geographies and all of that, but imagine that value migration also takes place within the same company from one business model to another. Right? For example, one of the listed food delivery platforms, right? Within the same company, you are seeing tremendous, two value drivers, where the newer value driver is actually becoming more powerful than the earlier value driver. So one has, as an investor, one has to keep an open mind of how value is migrating and keep following that migration. If you cannot anticipate the value migration, the best you can do is to follow the value migration.
Okay. And to put it very simply, value migration is something where the company remains in relevance. The number of satisfied customers are huge. The addressable market is large, and the serviceable market which you spoke about is something you need to identify. So value migration is nothing else but perhaps connecting the dots with simple common sense.
Yes, but as they say, there's this book called Uncommon Stocks by Phil Fisher,
Yeah.
right? And there is a quote there that common sense is not so common. So I think those investors who can adapt will make it big. Nikunj, I would also like to point out that value migration is a constant process. It keeps migrating from weak players to stronger players. It keeps migrating from the rigid players to the agile players or the adaptable players, and is a function, and it reflects the shift in the value creating forces. What are such value creating forces? Conventionally we talk about margins, we talk about market share, we talk about flow of talent, but really speaking, value is shifting between industries, between companies, between geographies, and between business designs and business models. Value is also shifting from old factors of production to newer factors of production. So many years ago, labor was the most important factor of production. Then we thought capital was the more important factor of production. Technology is the most important factor of production. Value also shifts from non-scalable models to scalable models. And these are the subtle distinctions that each investor has to appreciate to pursue terminal value and to pursue value migration in the context of terminal value. We have seen many examples globally and locally of such value migration. And as I said, it is not just limited to technology. We've seen companies like, say, a listed pizza company, how it disrupted the business model of the conventional restaurants and so on. Did it get disrupted by the newer food delivery platforms? Did it embrace the change? Was it proactive enough? And if it is, then hopefully it will have moved to the next S curve. But if it doesn't, then there are risks. We've seen India's largest rating company listed, and there have been so many shifts in their business models that we've seen over the years. From being a pure rating company to being a ratings and, let's say, research company, even the scope of the research that they offer has kept on undergoing change. So value is constantly migrating over time as well as over across players, and your future competition is going to be different from what it was in the past. But while that is true, you are going to be playing different games as well as compared to what you were playing in the past. So it is an unconstrained mindset of today's leadership that will determine the value creation.
Like a Morgan Stanley will never get the permission to do debt rating? Is it a law which the country has? Globally also, like S&P does it. Is the law they have made?
The law is that you have to be an independent rating agency.
Okay.
So you cannot, if you are doing the rating, you cannot yourself be dealing in those securities as well.
Okay.
And Morgan Stanley would prefer to make far more money on investment banking than it would on the rating.
How much money do they make in, let's say, rating a paper? It's not much.
In India, there are two kinds of fees. One is known as initial rating fee and surveillance rating fees.
Okay. This is from the standpoint of CRISIL. Okay.
The initial rating fee, depending on the size of the issuer, is in the vicinity of 10 basis points.
Oh, that's it.
The surveillance rating fee, depending on the size of the issuance, is in the vicinity of 2-3 basis points.
कुछ ज़्यादा है नहीं basically.
So,
And a merchant banker would make 4-5% when you take a company.
no. In equities, maybe 2-3%.
Okay.
But in debt, merchant banker will make 40-50 pips.
40-50%. And M&A is what, 4-5%?
Depending on the size of the M&A. So, much larger M&As, you will not get more than 1%.
Okay.
Very large M&As.
Well, in this episode of Masterclass with Utpal Seth, we've looked at value destruction, value migration, value creation in the context of terminal value investing with very fine examples. But in the next episode, it would be value fragmentation. It would be the concept of winner takes it all, and more importantly, value concentration. That in a sense will give you a summary of creative value destruction, the full circle.